Okay, so just a quick little glimpse of this week. We've been pretty busy, if you couldn't tell through social media. We usually, what we like to do in the club is provide a little bit of transparency and give you guys updates on what we're doing on a day-to-day basis. But Abby, if you want to give a quick update on the C competition.
Yeah, so we had our C competition this Tuesday, the 24th. We had 8 participants, and then we had a winner. The winner was InstaStim right in the middle, and it was a really great opportunity. We got to give them $2,000 that we sourced from the National Association of Community College. And yeah, it was just a great event. Got to see a lot of great businesses, and yeah.
What was like the competition like? How did it go?
It was just 8 businesses, and then one after one, they were pitching 3 minutes. There were 4 judges. 2 of the judges were from 161 Ventures. I'm not sure if any of you have heard of them. They're based out of Gainesville, Florida. But yeah, there was just a lot of good Q&A, and yeah, it was just a great event overall.
Sorry for losing on that. Let me share the screen real quick. This week I presented at the BCC just a quick presentation on how to be an effective president. The president over there asked me to go present. If any of you were there, let me know how I did. But I think I did okay. But open to feedback. We usually do like council meetings for BCC, so it's like a kind of like a consortium of all the clubs within Henry. And so far we've made some great connections over there. We're looking forward to the future with them. And Grant, today was like kind of like a ad hoc business bash, but over in the Gerson Courtyard. I think that's what it's called. Yeah, it was just a tabling event. Met some cool people. If you guys were there today, thanks for coming out for tonight. But yeah, just pass out some candy. Actually, we have some candy if you guys want some. It's gonna be here in front. Some Snickers, some Skittles. You guys can come grab it if you want. Or you guys want to pass it out? Oh.
Yeah, just pass it around.
It's just like take one.
Yeah, grab some. You guys want? And for those of you who are new, we like to do pizza sometimes, and we'll let you guys know ahead of time. Today we're not going to do pizza, but just keep an eye out for that. Okay, and yeah, some other updates, some more transparency. In addition to these GBMs that we provide you guys, we also have an analyst program happening in the background. So also due to the nature of some of these engagements with Innovate, we have some like discrete project names for these companies. So Project Horizon is like a med tech company, and we have 5 analysts working on market research for them. And they actually met with the founders this week. Some pretty good engagement. And actually some pretty exciting news. We're launching a new project, and we're going to be recruiting analysts from our analyst pool pretty soon. So if you were just inducted as an analyst, please be on the lookout for that. And yeah, Avi already provided updates on the C competition. And something that also happened in the background was we also consolidated a partnership with the engineering school. So in the future, we might be hosting either a seminar or meeting in the new Malachowski Hall. So some pretty exciting stuff there. Maybe even a competition at some point. But we're still developing the details there. You want to give an update on FPD?
Yeah. So today I met with FPD. There's a few updates from that. One, on November 3rd, we're going to have a lunch with FPD alumni. Anyone's welcome to come and just have lunch there. So that's just one event. Another is a Miami site visit that we're planning on doing January 24th through the 26th. We're looking to partner with a bunch of venture capital firms down in Miami, venture and private equity, and hopefully get a good trip going there. So if any of you have any connections or are interested in the trip, please let us know. And yeah, I think that's all my updates for now. So
Just to piggyback off of that, so for the Miami site visit, this past summer I worked in PE, so this is right up my alley, but we'll be visiting the firm that I worked at, the director who hired me, and he's extremely attracted to just, bringing U.S. students to the firm. I think that's super important, and having somebody like him who worked at Guggenheim, which is a small elite boutique investment bank. They do a lot of things that are very niche, and they work in very niche industries. So he's very keen on only hiring UF students. He was a UF alum. He went to Columbia for his MBA, but he's very interested in hiring U.S. students. So I think it would be a great opportunity if you guys would sign up or attend the trip. Meeting guys like that is like second to none. They don't come around too often. And having somebody like that that would hire U.S. students is super beneficial. But also, to add one more thing, we're also planning a New York trip that is slowly getting off the ground for spring. We're in contact with firms like Citibank, Blackstone, Evercore, so pretty big names that would be kind of cool to go visit. We're going to be going through their trading floor, going to visit some alumni, and just kind of build connections. So we'll be, I'll tell Jerome more details on that, and if you guys are part of any FPE sector, we'll be giving, more updates on that as well. So
Yeah, if you guys are interested, just come up to us and we'll jot your name down. Again, so some more transparency. This is everything we've completed in the past so far as an organization. You can already see Santa Fe bid competition and the summit that we went to a couple weeks ago. Project Alpha is that new the new company that we're working with, so be on the lookout for that. And what's really heavily being planned into the future is the venture capital investment competition. That's going to be a huge event for us next semester. We're going to do a big reception there, bringing a lot of alumni and a lot of venture capitalists. So be on the lookout for that. We're going to provide you guys much more detail into the future. And then we also have one more project coming soon. We'll give you guys an update on that too.
All right, so for our current event discussion today, we're going to be looking at CVS. So CVS is a store that we all go to regularly. They have a lot of products that we use. This is based on their pharmacy division. So they recently purchased a company called Signify Health. So this is a healthcare service that goes to people's homes, and then while they're at these homes, they will be able to diagnose and then give treatment to their patients. So this acquisition is meant to be a vertical or a horizontal transaction for CVS and looking towards their business model in the future. Or what do you think it could be?
Vertical.
Why do you think it would be vertical?
They're buying pharmaceuticals so they can produce more. Like, instead of having to buy the medicine from a different producer, they can produce their own medicine.
Well, it's the at-home service for the Signify Health versus like making the actual drugs.
Then horizontal.
I think vertical because the healthcare company provides the clients to CVS basically. Like they diagnose the people, so the people then go to CVS. So basically they're like getting the supplier, I could say, something like that.
Yeah, so it more closely intertwines them with their customers and people that are looking to receive CVS's services. So it is, like you said, vertical alignment, and Andre said. So this acquisition is aimed for a quickly growing market and value-based care, and this has been growing since 2020, primarily due to COVID. Do you think this purchase of $8 billion was financed more through equity or debt?
Probably equity.
Equity. So CVS actually didn't sell a lot of their shares whenever they were buying the company, but they raised a lot more debt. And is debt or equity cheaper for CVS to use? So leverage.
All right, is debt or equity cheaper? How about in the back? With the backwards hat. Your name and then your answer.
I don't know.
Well, take a guess. Well, first of all, what's your name?
Ryan.
Ryan? Okay, Ryan, take a guess.
Debt.
Debt? Good answer. Good guess. Yeah, that is cheaper.
Why is that?
That's a good question, too. So we have a couple slides at the end of the presentation that go over why that is. But when you think about, I'm going to throw some words out just to explain this, but it'll make sense. When you think about a capital stack,
Yeah.
debt is paid first. So when you think about raising money, we'll use this example, to buy a house. You put a little bit of equity in with the idea that the equity can grow, but really you put a little bit of equity in because you can't necessarily afford the entire purchase. The rest of it is financed through debt. Now, debt is cheaper. When you think about how you can apply this to a company and think about the returns to people who own the debt and the returns to people who own the equity, the debt is cheaper because it gets paid first. So if you can't make your mortgage payment, what happens to your house?
It's taken further.
Exactly, the bank takes it, right? So the lender always gets the cash flows first before the equity holders do. And that's why debt is cheap.
Less risk is how you can price it, so that's why.
You could also say that the interest on debt is tax deductible, which is a pretty common interview question. So, like, yeah, they'll literally just ask you, what's cheaper, debt or equity, usually? You can make the argument for both, like, depending on if, like, you leverage a lot, if, like, you know, equity would be cheaper. But for the most part, 9 times out of 10, debt is always cheaper. Because the interest on debt is tax deductible. That would be the point.
Does it have anything to do with beta? Like something related to that? I don't know.
To pay down?
To beta.
Oh.
The beta you use in the DCF.
Yeah, I mean, like Alex mentioned, and also the note on debt being tax deductible, when you think of equity, over time, you're expecting the value of your equities to increase. And that's an inherent risk you're taking by putting your capital down on the house. So with the debt though, it's a guaranteed fixed income return. So less risk entails a lower return. Higher risk of the equity valuation inflating is more risk.
Okay.
Is there any?
It's all good.
All good there? Anybody have questions there? So CBS financed this transaction largely through debt. Seems like a pretty big acquisition. CBS has been pretty active in M&A pretty recently. Putting up a pretty good fight against Walgreens. So let's continue.
Yes.
If you have the money to buy it straight out, is it better to just buy it, or would you still try to finance it through debt? If you have like the.
What do you think?
So repeat it again. So if you have enough money on your balance sheet and you want to buy a company through equity, 100% equity.
Yeah. Would that be better than still financing it?
Yeah. So a lot of companies do that actually. So Tesla just did that very recently. So they have a lot less cash on their balance sheet because they acquired like a huge stake in another like conglomerate. Anyways, conglomerate is like another business that has like segmented revenue that have nothing to do with each other. So Tesla purchased like a single conglomerate or a single revenue segment from another company, which is pretty strange. But anyways, to answer your question, sometimes I would say yes, it's better, but also no. Also depending on rates. So if rates are higher, you probably don't want to leverage. You probably just want to go with the equity transition. However, if you buy with equity only, remember, you still need cash in your balance sheet to fund operations for, you know, if you're gonna like be, you know, acquire another company. So you want to have enough cash in your balance sheet so you could actually, you know, fund operations. But if rates are low, I wouldn't see a problem with leveraging a little bit of debt as well. So
Another cost that goes into using all equity or all cash is the implicit aspect of it. So you can also use that cash, like you said, to fund your operations, but also to fund new projects or potential other acquisitions that you could use that cash with leverage to fund acquisitions or expanding a new product line. So having capital on your balance sheet is very important. That's why leverage buyouts are also a very strategic financial tool. So we're about almost 3/4 of the way through our stuff, through our content. We have some pretty good topics coming up pretty soon. Want to make this announcement first before we get started. November 9th, we're going to have a huge event. Alex, if you want to also add on to it. We're going to be hosting a VC, private equity, and growth equity panel with some absolute goats, for lack of a better word, from all across Florida. And we're going to have a VC moderator asking them questions. If you guys have any questions that you want to ask these professionals, please email the UF Warrington email. It's going to be November 9th. Is Brian Hall locked in?
Yeah, it's soon to be.
Soon to be. You want to add anything?
Yeah, pretty much what Jerome said. November 9th in Bryan Hall, we're going to have a ton of people from different industries come. A lot of people are traveling for like far distance from this, but some really big players in their industry. So it'll be like a great experience just to hear what they have to say. So everyone should definitely mark their calendars and come.
Where can we get a list of the individual companies so we can do prior research?
Yeah, well,
Great questions.
We're gonna have that like a week prior, so we'll send that out either through the newsletter or just through a mass list. But you guys will get it. Okay. Just keep on your calendars. Make this will be able to.
Yeah, for sure.
All right, let's get started. I'll be on the side.
All right, thank you all for being here. Sorry I missed last week. So as I always do, we'll start off with kind of the dictionary definition of what is an LBO. An LBO is the acquisition of a company using a high proportion of debt by leveraging the cash flow and assets of that company. So kind of in more, even though that's in plain terms, you're buying a company with a lot of debt. And that's what you can take away. If there's anything that you take away that. And LBO is buying a company with a lot of debt. And you can see that in the diagram here. Let's say a company has $100 million in enterprise value. An LBO would acquire that company with 70% debt, which is the 70 million, and 30 million in equity, which is just 30%. Some key terms to understand when we're going through LBOs is collateral. So collateral is important both on the side of the borrower and the side of the lender. If I'm a lender and I'm writing a check to give out a loan, collateral is kind of my insurance policy. And collateral is security to me that if the borrower cannot make their loan payments, I have some type of backstop. I have something that I can turn to and take from them to try and make myself whole, to try to recover some of my unpaid principal balance. Now on the borrower side, collateral is important because it's what you're risking, right? If you take out a mortgage, which is a loan, your collateral is your house because you understand that if you can't make your interest payments, if you can't make your loan payments, the bank's going to take your house back. So that's what collateral is, and it's very relevant when you're talking about when private equity companies will buy out companies through LBOs, the assets of that company are seen by the lending institution as collateral. When you have this idea of tranches and senior debt, which kind of falls into our earlier conversation, we were talking about the cost of debt versus the cost of equity. So a lot of times when you have this $70 million chunk in debt, it's not all going to be through one loan. If one bank were to originate $70 million and be entirely responsible for the leverage on this deal, that would be very smart on behalf of the bank because there's a lot of risk in originating a loan that big. So what will happen is this debt, this $70 million, is going to be stratified across different levels of debt. So some debt will be subordinate to other levels of debt. And this goes into the idea that debt is cheap because it gets paid out first, right? So if you have a senior, it's called a senior lien, you have your senior note, your senior debt, which is probably going to be the biggest chunk of this 70 million, that's going to pay out first, and then you're going to have subordinate pieces that each have higher returns, each have a higher interest rate, which presents a higher return to the lending institution. And that compensates them for getting paid second and third, and then all the way at the bottom of the capital stack, you're going to have your equity. Sponsor is a term that we've seen a couple of times throughout our presentations in Warrington Ventures curriculum. So the sponsor, for the purposes of LBO, is the entity that's putting this entire deal together. Then you have your underwriting and your due diligence, which is done both on the private equity and the investment banking side. The investment banking is kind of brokering this LBO. Both parties, especially the lending institution, are going to be underwriting this LBO, and that's why it's important as we're going and looking into pursuing some of these careers to know how to work out these models, because both parties, both on the kind of speculative private equity side, how much return, what is the return I could get? Is this a good buyout opportunity? And on the investment banking side, is it wise for us to originate this debt? You want to know, you want to underwrite the deal, you want to make the LBO model, and come to a consensus as to whether or not you think this is a good idea.
To add one more thing. First of all, excellent explanation. So, has anybody ever heard of the term dry powder? Anybody here has ever heard of dry powder? Does anybody want to take a guess of what dry powder is? No?
Pick on.
Yeah, all right. Drew, you know what?
Dry powder?
Yeah, you know what that is?
No idea.
All right, so I'll explain it real quick. Oh, we got one back.
Cash on hand.
There we go, perfect. Did you go to Market Monday? When I presented? There we go. Okay, perfect. So, dry powder is essentially cash on hand to fund operations, right? It's just kind of a slang word. It originated from like battle, 1800s. Anyway, I'm not getting into it. But anyways, going back to what we were talking about in debt, and I think it's very important, is that when you purchase a company through debt, when you leverage a lot, the bank needs to know that you're going to pay back the loan. And there's several factors that they look at in order to understand whether or not the loan can be paid back. And one of them is dry powder on the balance sheet. So a PE fund will have a lot of cash on hand, but the bank wants to know, okay, if they have a lot of dry powder, then their credit worthiness is probably pretty high. That means that they can pay back the loan in the future, right? And another thing I just wanted to hone in on, an LBO is nothing more complicated than buying a house. It really isn't. It sounds complex and the models get really intricate, but on a basis level, on an elementary level, it's just your mortgage is your debt, the acquisition cost or the enterprise value, let's say the house is worth $1 million, right? And you'll have a debt $800,000 and you have equity of $200,000, and those two combined will meet the acquisition cost. And if you notice, I picked a very small amount of equity, which was 200,000. Picked a pretty large amount of debt, which is 800,000. So my capital structure is 2080, right, or 28, or whatever you want to call it.
That's common for home loans.
Yeah. So yeah, and which is also pretty common for LBOs, is that you're going to have very, very high levered deals, right? And the capital structure is going to be very skewed. 9 times out of 10, you won't have equity that's higher than debt, just because going back, debt is cheaper. You can pay it off, and it increases returns. So yeah, so it's nothing more than just buying a house. If you get confused, just think of buying a house. Yeah.
So here are some of the key participants. I'll go down to the next screen.
We have a little matching activity for you now.
Yes, great matching activity. So if you read through them really quick, I'll give you a couple seconds to do that. We're going to go down on the left from target management down to bond investors and match each one slide at a time. So if anyone knows what target management is or would like to take a guess.
We'll just number these 1 through 6, or 1 through 5 for simplicity. When you're all at your answers.
Maybe get out of the way.
All right, let's try backwards hat in the back, and this side, name, and give target management a shot.
Jonathan Gupton. I haven't had a chance to even read them yet.
All right, yeah, take your time. Take your time.
I'm trying to squint a little bit.
All right, well, you work on target management, maybe someone can help you out.
Okay.
Does anyone have an idea for financial sponsors? Yes.
It's not for financial sponsors, but I'm gonna guess lenders goes with the third one. I don't know.
Yeah, that's right.
That's a good one.
Your slide actually has the line that connects it, but
Yeah.
that's right. So lenders is good. Any ideas for target management?
All right, he's going to figure out target management. Who's going to do sponsors? Or you do sponsors?
Yeah.
And then,
Financial sponsors?
Yeah, would that be number 2?
That
Playing
would-
the role both as the financier and the advisor?
Target management, any ideas before we move on to number 2? Just gotta call it 1 through 5.
4.
4?
I was gonna say it.
That was 5. So target management, John, you wanna take it?
Sure. So target management plays a crucial role within an LBO. So they look at investment for merits, and then the company, if they should be buying it, and then they will be working with that company for the financing terms, and they often hold equity within the company, and then typically towards as well. Or multiple places.
Okay, so let's go back to financial sponsors. Your guess was
I
2?
think it switched now to, it moved the order down.
Okay.
Would it be 4?
No, financial sponsors is 1.
Only 2.
So financial
Take
sponsors.
Andre next. Glasses.
Investment banks though, Andre, did you know which one investment banks would be? Can you read it?
Yeah.
The 4th one?
Yes, that is correct. Investment banks may play a role both as a financier and an advisor. They facilitate the purchase and sale of companies. They're actually broking the LBO. Like I mentioned, they perform due diligence on the target and the sponsor. And they may sell different tranches of debt to investors. So investment banks have their hands all over this process on both the debt side, actually facilitating the technicals of switching of ownership. And then when you dispose, and you typically an LBO for a private equity company, for instance, is going to have a certain hold period. Investment banks are going to help dispose of the acquisition. You either sell to someone else, bring it public, so on and so forth. Okay, only 2 choices left. Any idea for lenders? Yes, name and then answer.
Connor in 2.
There you go.
I also have a question about
Yeah.
that. What is amortizing?
Very good question. So amortizing is, let's go back to the house analogy, right? What are the components of your mortgage payment? When you buy a house, right, and you take out a mortgage, and you pay your mortgage every month, do you know there's 2 components to mortgage payment? You know what those are?
Is one interest?
One is interest, what's the other?
I have no clue what the other is.
So the other one is principal. So there's going to be an interest rate, which is the cost of you borrowing that money, right? And then when you pay your mortgage every month, a portion of that payment is going to go towards interest, and a portion of that payment is going to go towards principal. Now, because of the mathematics of how this works, at the beginning of the process, the vast majority of your mortgage payment is going to be interest. But over time, as your principal payment reduces your remaining mortgage balance, there's less interest that there's the potential to actually charge, right? If you're paying a little bit of principal every month, that's bringing the balance of your loan down. So every month when that interest is being charged again, it's being charged on less principal. Does that make sense?
Okay.
So slowly, that actually changes to where by the end of your mortgage, you're paying mostly equity, you're paying mostly principal, you're contributing more towards paying the loan off and less interest.
Okay.
But that entire process of taking out a loan and then slowly over time, you build equity in it, you pay the principal down, that is amortization.
So the interest you're paying monthly directly correlates with principal?
What do you mean by directly correlate?
Yes.
Yes, yeah, it does. Yeah.
Okay.
Yeah, it does.
I think also similar to a loan, also amortization goes with intangible assets. So how you guys depreciate, say like maybe a building, and you have to write down the value of the building, and that goes into the accumulated depreciation account. You have to amortize intangible assets as well, and bring its value down, similar to how you do depreciation.
Great point.
So that would be a patent or copyright.
One question.
Yes.
Amortizing also goes with bonds when you buy it with a premium or a discount?
Yes.
Okay.
And then the last one, anyone got a guess? It's really hard.
Wait, aren't they all connected?
Did you get it the last time?
Yeah, I mean, they would have known anyway, it's an awesome one. But, yeah, bond investors purchase the high yield bonds issued during the LBO financing process. Bond investors perform their own due diligence and targets liability. Oftentimes there are road shows, that kind of price that the investor makes will put on to price these high yield bonds, right? And then those bonds being issued will be used to see as, they're high yield bonds, they're part of that more subordinate debt in the capital stack. So what are the characteristics of strong LBO candidates? One of the first characteristics is growth opportunities. And you could measure growth opportunities is top line revenue. Now, why do we look at top line revenue for growth opportunities? Well, it's close to the customer. It's indicative that if there's high revenue growth, the company's either gaining market share at an attractive pace, or they're selling more units, or selling more units of whatever products or services that the company is good at. It also means that there's more cash available to us for debt repayment, and there's better opportunities for EBIT growth. That's because everything that happens down here when you're looking at an income statement, that's not possible unless we have something good happening up here. This is negative. How could we be reducing? I don't know how it could be negative, but if this is negative, how could we possibly try and do an LBO and make the company more efficient, add value, reduce costs? You have nothing to work with, right? So everything that happens down here is completely dependent upon what happens up here. So when you're looking at growth, you want to see a lot of revenue, you want to see growth in market share, and you want to see the company selling more products or services.
The next characteristic of a strong LBO candidate is a leading defensible market position. So when you're looking at this, you're looking for a competitive advantage that the company has. So they have their market in an area where they're able to perform. And if they don't have this moat of economic competitive advantage, then it's possible for the private equity company to build this moat, whether that be through their technology, their brand identity, operational efficiency, large capital recruitment, patents, etc. So that's the moat that they're looking for, either to build or to that's already developed. And then this competitive advantage can be established and measured through Porter's 5 forces, being the threat of new entrants, the threat of substitutes, the competitive rivalry, bargaining power of consumers, and bargaining power of suppliers.
Right. This idea of an economic moat is very important. This idea of trying to define and I guess quantify, but also qualify competitive advantage. There's lots of different models for doing this. You're going to learn a lot as you progress through the Warrington curriculum. Porter's 5 forces, SWOT analysis, VRIO analysis. But you kind of get the understanding of what this idea is here. It's how competitive can the company be within its universe? What opportunities present itself? What makes this company special among its universe and in its industry? And if it could either already have a very well-defined moat, or the private equity company sees it as there's an opportunity to build a moat, right? There's potential there, and they think they can get a good deal on the company and add a lot of value.
So an example of, or a bad example of this would be like different drop shipping brands that are selling the exact same thing. There's no really competitive advantage they have over each other. They're just trying to lowball for the prices. So another characteristic of a strong LBO candidate is the low maintenance capex. So this is the capital that a company is using to maintain their business, versus the growth capex, which is the capital that's being invested into growing the company and the amount of capital that's being used. So some examples of high maintenance capital is a shipping company. If they're at a port and they're having to pay $10 million for a crane, they're going to have to pay for the maintenance, and then if the crane breaks, they're going to have to pay for a new crane. Same thing for the truck. So this is the world's biggest dumpster truck, and if you're an excavation company, you're looking at $10 million for a truck, and that's just a large amount of capital that you're going to have to pay if you're trying to expand your business. So with this high maintenance capex, you're looking at more uncertainty and risk in an economic downturn, as prices may increase significantly, or your dry powder just isn't there and you don't have enough dry powder to purchase these the things that you need to run your business or maintain your business in the long run, in case that your actual services and revenues are decreasing.
You know, I would think about it like this, right? If, let's say your business is you take in these shipping containers from these cargo ships, right? And you have to buy $10 million cranes in order for you to actually facilitate your business operations, right? How many cranes? Well, first of all, assuming you can afford an unlimited amount of cranes, how many cranes can you feasibly fit into your area, right? Let's say that your port can only fit 10 cranes. Well, if 2 of your cranes have problems, if 2 of your cranes breaks, then you're losing in, assuming that they each generate a pro rata proportion of your company's revenues. If 2 of your cranes break, you're losing 20% of your revenue, and 20% of your business goes away overnight, right? If one person operating one of these cranes makes a mistake, and one of your cranes goes down, then you're losing 10% of your revenues instantly and 10% of your profits. So you have this idea that a lot of these companies that have these high maintenance capex requirements, the revenue is very clunky, right? Someone operating this truck can make a mistake, and that has nothing to do with the viability of, say, the business model or the strategy. It's simply just because they have high maintenance capital requirements, and you have to be able to expect that, and you have to plan for that. You have less cash on hand to actually pay down your debt, right? And here's another risk. Let's say that I know for a fact that the only company in the world that makes these shipping cranes is a Chinese company. So let's say that one day the exchange rate between the dollar and the yuan works against our favor, right? So yuan's become very expensive relative to dollars. Well, now all your repairs, maintenance costs, cost to buy a new crane set if you want to expand, that all goes up, and there's really not a lot that we can do over here to actually mitigate against that risk, right? So you have this idea that high maintenance capex companies carry a lot more uncertainty with them. The revenues are a lot more clunky, and then when you're looking at it from the perspective of what is a good LBO candidate, we don't like to see high maintenance capex.
So does anyone know why a strong asset base is important for companies and that you're looking into investing in and doing a leveraged buyout?
Right, and just strong asset base comes from here, because we also like to see companies with a strong asset base. Not necessarily high maintenance capex, but a strong asset base.
Just wanted to jump in and add one more thing. So, although these are all very explicit explanations about what makes a good LBO candidate, it's very rare to find all of them into one company. So this obviously adds into the risk factor, right? So sometimes you'll get lucky if you even get maybe 1 or 2. Like you have a low capex, you have stable cash flows. But another one that a lot of private equity firms look for, or just anybody who does an LBO, just a preference, you don't have to be a private equity company to do an LBO. If you're just a very wealthy person and you like to take risks, I guess, you can do an LBO. But they also look for stability. Stability is huge. An insane amount of volatility is not a very good thing when you buy a company, right? If it's a cyclical business, meaning that if they have high revenues at one time in the year and then low revenues at another time in the year, you don't really want that. You want usual like consistency. So that could be consistency in revenues, cash flows, consistency in liability expenses, consistency in loan repayments, whatever it is, because that will give a good projection of what the company will look like in the next few years while it's on your portfolio, right? So when a private equity company buys a company, it sits on their portfolio for anywhere from about 3 to 7 years, depending on how long it takes to make it profitable or to sell for a profit. We're going to touch on IRR and MOIC later, but those are just the metrics at the end of a model that pretty much explain how much money you're getting from the acquisition. So, yeah.
Do you know why it's important?
I'll let anyone else answer though.
We went over at the beginning, just as a hint. Yes.
I was thinking like, it'll show that the company has a lot of resources, but also like you can see how the previous owner of the company managed it. So for example, if they have a lot of liabilities, but instead they had a strong asset base, so it just shows like, kind of like what Nick said, they were playing in terms of like stability, making sure the company's stable and can perform well in the long term.
Right, that's not wrong, but it's not the answer that we're looking for right here. Yes.
Repayment.
Yes, in a way, so it's
There was a term, I don't remember the name, but
collateral.
yeah.
So whenever, if a business ever goes under, then the people that, their preferred shareholders, the people that own the company, would get paid out first for the company's assets.
These last three, we're gonna just breeze right through them. Strong cash flow generation. This goes back to the idea that they want to be able to pay that debt down. So you want to make sure that the company that you're buying can generate the cash flow required to do that. That's one of the primary goals of doing LBOs. Once you buy the company, you're able to pay that debt down. One of the primary strategies, rather. You want a proven management team, right? Do we know what I mean by management team? Ryan?
Yeah.
What do I mean by management team?
I don't know.
Oh, you got this, man. What, like, who manages a company?
Like the CEOs.
Yeah.
There you go.
It's the C-suite.
It's the C-suites.
It's the C-suite. And a lot of times when you do an LBO, a lot of times the previous management will get some compensation for it, but oftentimes the private equity company will kind of rinse and repeat, put their own people in there, kind of change direction, change course, give the company a little bit of new flavor. And then efficiency enhancement opportunities. So when I went back and I showed you guys that income statement and I talked about where the revenues were important, this is another thing that you're looking forward to as well, which is everything that's below the top line, you want to try to optimize. You want to optimize all of your expenses. You want to minimize costs. You want to change the company.
That was for Blue.
You want to change the company in a way that's going to drive value, make the company more efficient, and ultimately raise your bottom line. Okay, so last is the economics of LBOs. Not last. Next, we're going to talk about the economics of LBOs.
So there's two primary.
Could I just ask a quick question?
Yeah.
So you mentioned that what are good candidates for an LBO? Could you give an example of a business that you think would be good in LBO, or maybe talking about what you think the pros and cons of LBOing a laundromat would be?
Yeah. Nick, what have you seen in terms of good candidates?
So, this is an interview question I got last summer, and I said Study Edge. So, the reason why I said Study Edge, number one, Study Edge is pretty consistent in terms of their revenue, right? We pretty much all use Study Edge, all business students use Study Edge, right? They have a proven management team, right? They have a low capex. Imagine, guys, what are Study Edge's expenses? It's literally blue paper. That's it. They don't provide any type of physical product. They provide a service. It's a service company, right? So that's the company that I pitch. Another really famous one went back to the 70s. There's KKR when they purchased Nabisco. That was a $41 billion acquisition.
It's one of the first LBOs.
Yeah, that one was super successful in the sense that the limited partners, the LPs, they had a huge return. A lot of them just retired after. A lot of guys made $30-40 million from one deal, so they obviously retired. But yeah, so I've gotten asked that interview question, and I said Study Edge. So
Yeah.
Just to get my experience, yeah.
Yeah, that's great. And that's actually, it kind of checks all the boxes, right? But
Yeah.
let's go through here and we can do this as a group. Let's think about the laundromat. Revenue growth opportunities. What do we think? No? You shaking his head.
there isn't many really.
I would,
Five.
Nick, I'd love to hear your opinion on this.
Yeah.
I would say maybe the revenue's growing. Maybe.
So, everybody needs to do laundry. At every time, laundry will never go away. You always have to wash your clothes, right?
Right.
So that's essentially saying that the business will forever keep growing. People will always need to do laundry, right? So that is one box I'm gonna check. Number two, low CapEx requirements, 100%. The only things you need to run a laundromat are laundry machines and a physical building. That's it. There's really no employees that are at a laundromat. You probably have like somebody who just, keeps everything in line. You don't have a ton of like locations, I guess. I mean, I would also argue that like your bills are pretty low in the sense that, obviously let's put it in perspective. Usually laundromats are probably in lower income communities, which probably makes that the cost of rent is lower. You probably only have like a couple machines inside of the laundromat that are continuously like generating revenue. So that means their revenues are stable, their cash flows are stable.
Usually with the CapEx requirements, I think it might depend too, right? I'm not that
You could
familiar.
argue.
No, I'm not that familiar with what washing. I
think it'd be pretty high.
But relatively speaking, yeah.
Yeah.
In terms of growth opportunities, too, that's also kind of predicated that the area that the laundromat is in is a growing population.
Jerome, couldn't you argue that the machines will pay for themselves essentially after the long run?
I guess it depends on the bill and utility payments, but your water bill, your electricity bill,
Yeah.
also whether or not the laundromat's actually getting good like customers, or stable customers. I think it all depends, but if it is in the community that you mentioned, I think it would be stable.
Well, another thing to think about is like what's the maintenance outlook in terms of like how often do your dryers and washers break down, right? How often is there? You mentioned low-income communities. Sometimes that might come with crime. How often do you have to deal with security requirements, right? So, but when we think about how these LVOs are done, these are the conversations that people are having, right?
This is due diligence.
Right, exactly. Strong asset base. I don't know what the secondary market looks like for washers and dryers. Maybe when the bank comes to liquidate, they could get a good amount for those washers and dryers, but it's all a matter of perception and everyone's kind of how you underwrite, right? How much value do you as an analyst ascribe to those washers and dryers when you're trying to measure the asset base, right? That's gonna be on the balance sheet, of course, but do you agree with those assumptions that are being made? Strong cash flow generation. If you're a competent laundromat owner, you can probably generate strong cash flow, right? Proven management team, efficiency, enhancement opportunities. I think the weakest part that a laundromat probably has, and I'd love to hear everyone else's opinion, is its leading defensive market position, right? Because to me, growth opportunities for a laundromat is pretty dependent upon if the area is growing. Because you could also risk investing a lot into your laundromat and trying to scale in one area, but then like, for example, you have like a Rust Belt collapse and a bunch of people leave your area, or you have like this flight from New York to California because COVID happens, and then all of a sudden your revenues start to drop. So it's pretty dependent upon like demographic changes. But the thing about a laundromat is it's pretty much like a kind of a commodity. What makes one laundromat different from another laundromat, right? Now you might have a private equity company, and this is kind of getting into the minds of the people working there. They might think, okay, yeah, it's true. Laundromat is pretty much a perfect substitute for another laundromat. But then what could we do to go in there? If we were to buy it, and we could buy it cheap, because that's what everyone thinks. What can we do to actually develop a moat? What can we do to make this laundromat different and build out a competitive advantage? And these are some of the things that you're thinking about when you're thinking about buying a company is how could we improve and actually drive value here so when we sell it, we sell it for a multiple of what we bought it for. Anything to add?
So these are the two primary return metrics. So you have IRR, which is the internal rate of return, and then you have cash on cash.
Yeah, just to add one more, another important kind of metric that you would look at the end of the summary page in LBO is the MOIC, which stands for the multiple on invested capital. Sometimes it's called the money on invested capital, depending on what you're looking at. But essentially, what that means, just to give a very brief example, if I put private equity companies are run off of funds, right? So you have separate funds within the company that fund the acquisition of other companies, right? So if I invest $1 into a fund and it returns $3, my MOIC is 3 times, right? So if I invest $1 million, and you can get, the scale can get really big. If I invest $1 million or anything above that, your MOIC would be a lot greater because your IRR, your internal rate of return is higher. So a lot of these multiples play into each other. Like you'll see, like on a real model, on a dynamic model, there's something that's called a sensitivity analysis that you can run at the end, similar to like a DCF or like a comps. You can run one on an LBO, and pretty much that just gives like the LPs or the GPs, which are limited partners and general partners. Those are the guys that are funding the capital, right, or just allowing for these acquisitions to take place. And analysts will present these assumptions that they have made to the LPs and GPs just to give them an idea of worst case scenario or best case scenario, what's going on within the market.
So more detail on IRR and cash on cash. IRR, if you haven't already seen it in your curriculum, you're going to see it at UF at one point here in the business school. To measure the total return on a sponsored equity investment, including additional equity contributions on dividends received. And so mathematically, an IRR is the discount rate that must be applied to a set of cash flows that produces an NPV of 0. It's expressed as a percentage. In an IRR, the most important thing is it incorporates the time value of money.
And then cash on cash is the multiple, so however much money that a firm puts into a company, the amount of cash that they're putting in versus the amount that they pull out. You would divide the amount that they pull out by the amount that they put in, and then you get that multiple.
Wouldn't that also be like the one that you just mentioned?
Yeah,
it's MOIC.
Great. Yeah.
They just said differently. So this is kind of, for all the mathers out there, you might enjoy this, but this is just to try to demonstrate the mathematics behind finding an IRR, and this is the same mathematics that go behind discounting cash flows. So you have your cash flow 0, which they're assuming is an equity contribution, so it's a cash outflow, right? And these are all cash inflows on an investment. So I'm paying for an investment, I'm paying for a stock. And let's say the stock pays dividends, it's going to pay me cash flows over time. And so when you want to measure what the return is, what the IRR is, and a lot of investment returns are quantified as it pertains, they're quantified in terms of IRR. So when you're, as he talks about, LPs who are investing in these funds at certain metrics, you're going to communicate what the target IRR is and what your projected IRR is. You're going to communicate your expected returns in IRR, right? So how this is going to work is, this has an exponent of 1, so this just stays the same. But what you're doing is you're slowly, by multiplying, say this is 1.02 times 1.02, 1.02 times 1.02 times 1.02, it's going to be a bigger number, right? So as you continue to get farther away from cash flow 0, the number of the denominator is going to increase. And what happens to the entire value of the fraction if the denominator goes up? It's like 4th grade. Yes, down, right. If it's being divided by a bigger number, then the end number is going to be smaller, right? And that's kind of the idea of discounting cash flows. And so when this is applied to like a discount rate, like you're going to do when you take business finance, you need to find the present value of cash flows. This is going to way beyond the scope of LBOs, but when you need to find the present value of cash flows, this is how you're going to do that. This is why the present value of cash flows in year 5 is less than the present value of cash flows in year 0. Any questions? Okay, cool. So how are returns generated? And there's 2 ideas here that kind of hone in on the different strategies that private equity companies will take when they're performing these LBOs. And this just goes to show the important thing to pay attention to is that the IRR and the cash return are the same. So there's kind of 2 ways to get here to this return metric when you go through your hold period and you sell, right? And the first way is debt repayment with no enterprise value growth. So you put 25% down on a company, right? So you have $750 million in debt in your LBO. Now, as you get cash flows from owning the business, and this is why a focus on free cash flow is important, and a focus on the cash flow generating potential of business is important. Because this shows you're going to take some of that cash flow and put it down to repaying your debt, right? So you have $500 million in cash flows, that's going down to paying down your principal balance. So now when you sell it, you only have $250 million in debt. And what this example is assuming is that you're selling it for the same amount that you bought it for. But you're still able to make an IRR and a cash return because your equity is going from $250 million to $750 million. And all that you're really doing is owning the company and taking the cash flows and paying down the debt that you bought the company for. And a different example, where you accomplish the same IRR and the same cash return, you're buying the company for, again, 75% debt, 25% equity. This is an error, so go to sale, it's $1 billion purchase price. But in this instance, you're driving value, right? So maybe instead of paying down the $750 million in debt, you are taking that cash flow and you're reinvesting into the business, you're optimizing the business activities, so on and so forth. You're putting that money to work in a different way. And you suggest that you can, if you sell it for $1.5 billion, you're making the same return, right? So there's kind of two ways to get here, and these are kind of the two overarching private equity strategies. You can pay down the principal balance and sell it for, of course, what you're sacrificing, the opportunity cost here is the potential to reinvest that money and drive value in the way that you think that you can, right? And there's a way to kind of keep that free cash flow, put it back into the business, and sell it for more than you bought it for. They're both going to get you to the same spot. And a lot of the calculus that goes into structuring these deals and designing these deals is behind how much debt do you repay as opposed to putting back into the business and doing it this way, right? And there's going to be a ratio of both that you think is optimal.
Could you explain what you mean by pay down debt?
Yeah. Yeah, so the debt started out at $750 million, and your equity started out at $250 million, and then you have $500 million of debt repayment, right? So let's say that throughout your hold period, it's a 5-year hold period, every year you put $100 million down, right? So obviously the cash flows that you're generating are, this is a very simplified example, but the cash flows that you're generating are enough to cover the interest payments that are also due on this debt. But if you have enough cash flow left over after interest to actually pay down the debt, what you're doing with the cash flow that the private equity company's not putting this money up. This is the cash flow that the business is generating. You're taking that and you're putting it towards the principal. So you're reducing your principal balance. So every time you're paying this $500 million to the bank, it reduces the amount that's left on your loan. So at the end of your hold period, you only have $250 million left on the loan, and you have $750 million in equity. But the equity was earned because you own the business, you're entitled to the cash flows, and you use that cash flow to pay down your debts. And then you're able to 3x your money and make the 24.6% return.
So that can be done if the debt's issued through bonds and there's a call date on the bonds, when you're able to buy back the bonds without letting them wait till the expiration, then after that call date passes, you're able to buy back that debt.
And then kind of a quick follow-up on that. Why is it better to pay down your debt, and like why is it important to do that as fast as possible?
Well, what this example is showing is that there's kind of two ways to approach this, right? You don't necessarily, like in this example, they didn't pay down their debt at all, and they managed to achieve the same amount of returns as you would here. Now, if I were to answer that question, I implore the people to chime in, but looking at this, it seems like paying down your debt is a way to hedge against risk, right? Because in order for this to work out and give you the same IRR and cash return as it does here, what you're assuming is that you can get the sale price to $1.5 million. You're assuming that you can drive enough value to get you where you need to be to achieve that return, right? You don't pay down any of your debt. You still have this massive $750 million debt liability, right? And then this is a risk that your LPs might not be willing to take. And then so when you're structuring these deals, that's one of the considerations that you're making is how much debt do we pay down as opposed to, how much can we bet that we can multiply the value, the enterprise value of the company? Yes.
Could you say another reason to pay off your debt quickly with that money instead of just holding it, even though debt is cheaper, is hedging against risk, but also reducing future interest payments you have to pay on that? Would that be another reason to pay it early?
Absolutely, because and this goes back to that original mortgage example, right? When I talked about amortization, if I have payments, and I have payments every month, right? If I have $750 million or $250 million, in which scenario would I pay less interest? $250 million, right? And that's what you would do because you're saving money paying less interest expense.
Yeah, so why would you ever choose that second option since it's more risky as well?
Because there's also, if it is more risky, you also have the possibility for higher growth with that money. So if you're able to grow your company faster than expected, then you'll be able to get a better return there.
On top of that, you can keep your free cash flow, right? So there's kind of a risk return matrix going on here. You might think that the money that you would have spent paying down the debt could be put to better use, buying assets, increasing market share, whatever private equity companies do. The C-suite might make an argument that they can use that money and grow the business by X amount. So it's all part of that. It's all part of that calculation that people in this space are going to have to make. Right? This is all part of the assumptions you make when you're building out the model.
Yeah, to build off on that real quick. So you would also it's the amount of research and due diligence that goes into one of these models is pretty intense in the sense that the companies know what they're doing for the long run. They know exactly what will happen in terms of when they have to pay everything down at the beginning. So there's this concept that's called capital calling, which is basically whenever you need more money, you call, not physically call, but you will approach your limited partners or LPs. That could be people, that could be endowment funds, that could be governments, that could be companies, anybody that's funding the acquisition of your company, right? And you can just say, hey, I need more money. You pledged or you contributed $1 million. I need 20% of your $1 million. So when you pledge funds to a private equity company, they're not going to just suck $1 million like straight up. They take it in increments. They take it in small amounts. So when they take it, they'll probably take it in percentages of maybe 30%, 40%, depending on how many LPs are in the deal. But when they need more money, they will go and get it. And obviously they let you know, and it's part of the contract that you sign, and you're obligated to give them that money at the end of the deal. Yeah. Mm-hmm. Go ahead.
Out of curiosity, raise your hand if you remember when we talked about capital calls a couple meetings ago.
I was going to say, ultimately, isn't the point of an LBO or even in venture capital to invest into a company, to exit the company, to harvest your investment?
Yeah, it's all about, you want to make it profitable. That's the thing we're trying to gauge here.
Exactly.
Profitability. We want profitability. So a lot of these companies are not profitable. So the reason why you would take it private is to pump money into it, fix management, cut costs, and then sell it off for a profit.
So a point of rapidizing the debt payments would be because it would be unappetizing for an acquirer to see a lot of debt on the balance sheet. Would that be a reason why they wouldn't acquire?
That could be a reason.
So to answer your question, I think that would be another aspect of it, for the actual harvest potential of the business, to rapidize the debt payments.
Thank you.
We also have this idea of leverage. So here's one example that we're going to show, an LBO finance with 25% debt. And just before I go through this next example is finance with 75% debt. So preface this with the next example. But in this, 25% debt, right? So you're going into this LBO, but instead of putting down a low percentage of equity, you're putting $750 million of equity as opposed to $250 million in debt. You're driving up value for a $1.5 billion sale price, and then with some of those cash flows, you're paying off $250 million in debt repayment, right? Your cash return, since you put $750 million in, and you sold it for $1.5 billion is 2, your IRR is 14.9%. Now, in this example, and this is how they're typically structured, you have an LBO finance with 75% debt. In this instance, you have $250 million in equity, $750 million in debt. You're assuming you have $500 million in enterprise value growth. You can sell in the open market for $500 million more than you bought for. And you're assuming that you have $118 million in debt repayments. So what you can see here is not as much of the of your cash flows are going to debt repayment, right? But because you paid down $118 million in debt, and you have $500 million in enterprise value growth, your equity value is now increased to $868 million. That represents a 3.5x return and a 28.3% IRR, and it's the same purchase and sell price. So this is the idea of leverage, and it borrows, the reason why we say leverage is because it's a term borrowed from physics. Each dollar of equity works a lot harder when you put less equity and you put more debt in. The risk is, and you can think about this when you buy a house, the risk is your equity could be wiped out, right? You can apply this logic to companies, but if I buy a house, I put 2% down. Okay, that's great. I put 2% down to get a house for super cheap. I don't have to risk that much money. But if I'm buying it, let's say it's an investment property, and the idea is that the value is going to go up. Well, if I only put 2% down, I'm wiped out. If I'm underwater, the value decreases by 2%, right? I'm paying a mortgage that assumes that the value of the property is higher than what the property is actually worth. That's why you put in a little bit of equity, because you have a cushion, right? Granted, if you only put 2% down on a property, but the value of the property then increases by 25%, you're multiplying your money. This is where the constant leverage comes in. Your money is going to, you multiply it, you're going to get on the money that is so much higher than if you had put 20% down and the property only appreciated 25%. And that's this idea of leverage. So these are 2 debt repayment timelines. And the idea of including these was not to go through them meticulously, but really just to describe this idea of leverage and the calculus, just to describe visually the idea of leverage and the calculus that goes into doing these LBOs, right? And a big part of it is how much debt are we going to take out and how much debt are we going to repay once it's taken out. And that's what a lot of these calculations aim to do. You have different debt repayment timelines. And these from the textbook that we source this material from, you have two different scenarios here in debt repayment, right? One of them gets you 2x cash return, the other one gets you 3.5x cash return. But when you're working the private equity shops, when you're underwriting these deals at the bank, a lot of what you're doing is looking at the different scenarios in which you can repay the debt and the effect it has on the LBO. Yes.
You mentioned earlier that like a lot of that debt is stratified across very different banks. Those loans, will you see that those loans will vary in the way that they're structured? So like one you might have like a 5-year arm, or like one might be a 20-year fixed rate. Like will you see like these different structures within the loans that are stratified across the debt?
Yeah, you will absolutely see. I mean, the biggest point of difference is going to be the interest rate. But in terms of, mezzanine financing, there's kind of a carve out there where you can actually take a step in and become like an equity holder if you default. So there's kind of different ways that these loans are structured. Yeah, you also have this. You also have sometimes. I'll actually just go to the slide. Sometimes you'll see in between mezzanine and common equity, there's like convertible notes as well, like debt that can be converted into equity. But the biggest thing that goes into these tranches is the interest rate, and like who's actually originating these loans. Because the senior debt is going to be by and this goes into different risk appetites of different firms. So the senior debt is going to be a lot of bank debt. They want to match their assets and their liabilities. And they want low risk and low interest rates because they have liabilities, they have obligations to their depositors. As you get further down, the firms that originate this debt are going to have a higher risk appetite. They're going to charge more interest, and those are the points of difference. If you have some funds that exist to provide mezzanine financing to acquisitions and to both when you're buying companies and buying real estate, you have funds that exist to buy subordinated debt, right? It all depends on your risk appetite.
So the reason those interest rates are higher for those at the bottom is because if a company does default and fail, then that money, the assets, the collateral that the company has will first be given to the senior debt, then the subordinated debt, then the mezzanine, then the common. And so they'll be paid out in full just going down the seniority line. So that's why the interest rates for the people at the bottom are higher, because they're taking on the risk of not being able to get their money back.
Yeah, and this kind of seen in a different way. You're going to have your bank debt, and your high yield debt, your mezzanine, and your equity financing. And the last slide we have for you guys is just the exit strategy. So we talked about the $1.5 billion sale price. How does that actually happen?
So when you're looking at exit strategies, there's different ways that a private equity company can finish with their company and get their return on their investment. So if they do the IPO, the initial public offering, they're taking the company to the stock market and they're raising funds on that public trading platform. And then you have the acquisition from another company that's looking to either vertically or horizontally grow their business. Secondary buyouts, you're looking at other private equity firms looking to buy that company and then grow it themselves. And then dividend recapitalization is kind of funky. So the private equity firm will decide that they want to get paid out in some form. So rather than actually selling the company, they'll raise their liabilities by getting more debt, acquiring more debt, and then paying themselves out as the shareholders of the company, and increasing their leverage in that way, their debt to equity leverage. So it allows for liquidity without selling shares, and the private equity company is able to maintain their control of the company within this strategy.